All right, good morning, peoples. Back at you with Amazon and AMZY. So, what happened on 8/6 on Tuesday? Well, Amazon was up 0.57 and AMZY doubled that. I know they couldn't have been too excited about the disappointing declaration amount, but they decided to not worry about that and just go up. So that's good. I'm glad they didn't have an attitude like some of us. Um, all right. So there were 50, whoops, this is 8900. So 50,000 shares were added. They did not put, wait a minute. Yeah, this is 9,000. I knew it was nine. Okay. So they added 50 and 50 on the day. So whenever you see big amount of negative cash like that, what they're really doing is just pulled all the money out to pay, okay, the distribution. Because remember, they have to do that really the night of declaration and then send that to their sub-advisor, which does the distributions to all of the Schwab's, Fidelity, iBrokers, Robin Hoods, you name it, E-Trade. Um, so it has to be done in advance. And it's been really good with most of these. I think E-Trade is one of the laggers from what I hear. I know it. I don't love Schwab in general for a lot of reasons. I like Ameritrade so much better. I've only been at Schwab a few months, but in the transition over there. But I will say that the declarations are typically paid. Now, sometimes I'll get, out of owning 5 funds, I'll get 2 or 3 of the payments well before the market, right? So this time tomorrow I'll have them, and then some come in as the market opens, but they're very good in general about paying. I know Fidelity typically is very good as well because I get some in my tax-free account in Fidelity. Um, so those are the ones that I'm most familiar with. Okay, guys, let's finish jumping in here. So no trades put on. So what's the status? Well, we didn't have that great of month. We were doing great until earnings and the guidance, just like a lot of the companies. And then on top of that, we had the unemployment on Friday and Monday. So between Thursday, Friday, and Monday, it was terrible. We reported earnings on the first, and then on Friday the market fell, and then on Monday it fell huge, but recovered a lot of the loss, but still another net down. So Amazon, not unlike many of the other stocks, were hit pretty hard. So I mean, this 161, you figure it had a 203 not too long ago and was trading in the 190s, and then going into earnings we were in the mid to high 180s. So that's part of the problem. But when I'm tracking this fund and I don't know all the previous months carryover from an accounting standpoint, when I see that they collected, $1.14, I assume they're going to pay very close to last month and give us 74 cents. Well, they said, hey, you got a $38 million liability out there, and not being able to see the accounting from the previous months, then I don't have a feel for how much they're going to hold back. And after you do this for 2 or 3 or 4 months, then you build up your own accounting and you see what the carryover and what the reserves are and how they're going to treat things. And even then, I'm surprised, right? But your first month is always horrible, like Ybit. They collected all kinds of money, had a big paper liability, but it was a crypto. I thought they might pay 250 plus. They paid $1.37. So people are like, "Oh, you said it was 250 plus." Well, they had $6 they collected. but they also had $5 or $6 worth of liability on a paper value. So they just chose to pay $1.37. You can't know all that stuff. You can't be a mind reader. But, now that I witness it and I see it, so going forward, I say to myself, these paper liabilities, they're still liabilities. They just haven't been taken care of. It's like you take a big bank loan and, or a mortgage and you're going to pay every month. Well, you still have that mortgage liability. You miss a payment or two, they don't typically come and take your house. After about three payments, they can begin the foreclosure process. But it's a real loan liability, and those payments need to be paid, right? And so that's what happens here. Unless you just soar right back up, that paper loss on the synthetic is real. The only way out of it's a rising boat, right? A rising stock. Okay, guys, let's cover weeklies. This shows our calls are in good shape, ironically. I mean, we did write 185 here, but most everything, well, this one is 3 days. That should be pretty good on Amazon. 5% out of the money with 3 days. Um, this one, that one's one, no question. This one could get tight, but it's very small. So what we have there, we've won a lot. We're up around 87.94, right? Almost 88% we've captured. So let's go take a look on holdings. And where are we on our synthetic? This is the problem that carried over, right? This is the last day I keep the accounting for July, and then I'll switch it to August tomorrow and start moving forward. So you can see here that, we moved up $1 or so, but that was enough to take us from a 39 million to a 38 million loss. So we're still sitting there on the 200s, but those have to be rolled. So they could roll as early as this Friday, 8, 9, because there's not much left to gain, right? There's very little time premium when you get down to a week on something that was 6 weeks out. I mean, there is time premium, but it's minuscule for writing the large contracts. Whereas when you write a naked 1 week out, then every day can be a big. I mean, you think of it, whatever the 100% you sold something for, if you're still out of the money, that starts dissipating at 20% a day until it's all gone, right? When you write a 170 and the stock stays below 70, they're saying it's worth 27.5. Well, tomorrow it'll be 19, the next day it'll be 10, and then if it doesn't get there on Friday, it goes to zero, really. But the guys, they negotiate to buy it back for 1 or 2 cents. So that's how this whole naked calls get electronically settled, right? You don't just let it expire worthless when you're out of the money like you do in retail, because they're trading in Flex. And Flex allows you to select a European option. So when you sell puts and you sell calls that run into money problems, you can just electronically settle. You never get a signed stock, because as a single stock fund, they don't want to own the stock. The SEC says you cannot have more than 10% of your fund in a single stock. Well, starting to buy a bunch of shares of the stock, they would immediately have more than 10%. So that's why they do synthetic options to simulate being long the stock, and sell naked calls to try and capture um, income, additional income. It's when those calls get run by, they get exceeded, is when it pulls all the money that you're gaining away from the synthetic. And it's called or referred to as capping. Okay, guys, enough on the education front. Let's finish up here and see how we're doing. Let's see if there's something else I want to tell you. So 1849 and 1819. I know we're paying a little more than that, but that is accounting. All this stuff is done correctly up here. All right, let's go look at the payout. So it's the last time we have to deal with this. And again, we had collected one, since we didn't have any trades, nothing changed. We had collected $1.13. What I can't know is in previous months if they paid a little more and borrowed ahead and they didn't want to do that anymore. I know they collected $1.13. They only chose to pay us 47 cents. So they must have felt that that 38 million was a liability. And if look at on the shares, how much that is, divide 9 million shares by 38, you get over $4, right? That's $4 and, 30 cents. So you don't want to pay out all your money. You want to leave some in there. So they left 66 cents. And and I don't blame them, but I wouldn't know what they had from before, right? I don't have a track record to see how they're treating this particular fund. So we live and we learn. Okay, guys, again, this is Bruce with Targeted Wealth Creation. I'm not a financial advisor. This is not financial advice for fun and entertainment. Hope you were entertained. Okay, guys, bye for now. Have a great day ahead.